Welcome to the debate. Imagine spending like 94% of your paycheck on a house that might just completely dissolve in 3 years.
Right. Yeah, that's a terrifying thought.
It is, right? But that is essentially what the biggest tech companies in the world are doing right now. I mean, when we look back at these monumental infrastructure projects, the Hoover Dam, the interstate highway system,
Sure.
we intuitively grasp the financing because we understand the physical reality of the asset. You pour millions of tons of concrete, you issue 30-year municipal bonds, and for the next century, that concrete holds back water and generates a predictable return.
Yeah, it's permanent.
Exactly. It's permanent. But today, we are witnessing the largest, fastest infrastructure build-out in human history, with the multi-trillion-dollar AI compute expansion. And our concrete is silicon. We are essentially building digital dams with an expiration date.
And that physical impermanence fundamentally alters the math. I mean, a traditional asset outlives the debt used to build it. It's physically rooted in the earth. But with AI infrastructure, the massive tech hyperscalers, the Amazons, the Metas, the Microsofts,
Right.
they are burning just incredible amounts of capital to buy GPUs and build data centers at a pace that, quite frankly, cannot be sustained by standard corporate cash flows alone.
No, absolutely not. We are seeing these companies allocate nearly all of their operating cash flows to AI capital expenditures. It's unprecedented, which brings us to the core of our discussion today. Because these tech giants can't sustain that internal cash burn indefinitely, Wall Street has engineered this really fascinating, basically unprecedented financial pivot. Data centers, power agreements, and these huge racks of GPUs are being moved off of corporate balance sheets.
Right.
They're being packaged into asset-backed securities, or ABS, and they're being funded by global private credit. So a central question is this: does this financialization of AI compute guarantee a prolonged, stable boom that ultimately glides into a soft landing of, hyperabundant, cheap compute?
Or is this off-balance sheet leverage engineering just an inevitable, devastating sectoral crash?
Exactly.
I actually think it is the defining economic question of this decade. I mean, considering the sheer volume of capital flowing out of institutional funds and into these data centers.
I totally agree. So, I'll be taking the position that this is a brilliant, structurally sound evolution. I'll argue that by using structured financial safeguards and, really relying on the highly transferable nature of GPU compute, Wall Street has solved the fundamental capital bottleneck of the AI revolution.
Okay.
I really believe this ensures a resilient, sustained expansion that will lead us into a golden era of application where compute is so abundant, it just transforms every sector of the economy.
And I will be taking the opposing view. While offloading risk into the securitization market certainly extends the runway for big tech, I believe it merely delays the inevitable.
Merely delays it. Okay.
Yeah, I'll argue that the rapid obsolescence of AI hardware, which is basically driven by Moore's law on fast forward,
Right.
combined with the limitless flow of off-balance sheet capital, absolutely guarantees severe overbuilding. And this ends in a massive 2001-style telecom sectoral wipeout, leaving institutional investors holding the bag while big tech just walks away clean.
Well, let's lay out our frameworks in a bit more depth here. Because I look at this shift and I see an exact parallel to the birth of mortgage-backed securities in the 1970s.
The MBS market?
Yeah, the MBS market. We have to look at the mechanics of how bottlenecks are broken. Prior to 1970, a local bank made a 30-year home loan using its own local customer deposits, right?
Right.
It held that loan on its own balance sheet. Once the bank ran out of deposits, it had to stop lending. It was a structural bottleneck that choked housing access across the whole country.
Sure.
Then, Ginnie Mae stepped in and issued the first MBS. Suddenly, banks could bundle thousands of those local loans, sell them to global institutional investors, recycle the capital, and keep issuing new loans. The constraint was completely lifted.
Right, it opened the floodgates.
Exactly. And today, hyperscalers face that exact same balance sheet limit with their AI CapEx. You can only burn so much internal cash before your shareholders completely revolt. AI ABS solves this by tapping into global fixed income. And because its infrastructure debt relies on highly mobile collateral, GPUs that can be soft routed to other cloud tenants, and incorporates massive structural safeguards like 25 to 40% equity cushions, it is incredibly resilient. Even if supply temporarily outpaces demand, the result is just a gentle transition to cheaper compute inference, not this destructive crash you're predicting.
Well, I come at the macroeconomic picture from a very different way. The mechanism of securitization artificially extends the AI boom by bypassing those very necessary corporate balance sheet limits.
But why is that artificial? It's just a new funding mechanism.
Because by tapping into fixed income markets and global private credit, big tech avoids hitting their funding wall today. But that limitless tap of capital is precisely what makes a crash inevitable. I mean, GPUs are not 30-year suburban homes.
Well, sure, not literally.
But even economically, a home retains its fundamental utility for generations. A GPU is a rapidly depreciating asset. When you use off-balance sheet vehicles, you sever the crucial link between capital investment and immediate software revenue.
How so?
The capital markets start funding the construction of data centers based on projected future demand, right? They're building for a customer base that isn't fully there yet. When the inevitable infrastructure glut arrives, the combination of obsolete hardware and over-leveraged secondary cloud providers will trigger a massive debt restructuring.
I mean,
The hyperscalers might walk away clean, sure, but the pension funds and the insurance companies holding these asset-backed securities, they are going to face a brutal reckoning.
let me offer a different historical precedent then, because I don't think residential housing is the only or even really the best analogy for the underlying collateral itself. Let's look at the 19th century railroad boom.
Okay, taking us back.
Yeah, way back. So in the 1800s, American rail companies lacked the upfront cash to buy thousands of locomotives to cross the continent. Standard corporate bonds just weren't enough. So Wall Street created Equipment Trust Certificates, or ETCs.
Right, the Philadelphia plan structures, where an independent trustee actually purchased the locomotive and then leased it back to the railway.
Exactly the mechanism I'm talking about. And the reason that worked beautifully was because locomotives were mobile physical assets. If a railroad went bankrupt during the Panic of 1873, the trustee didn't lose their shirt.
Right, they just moved the train.
They simply uncoupled the locomotives, rolled them down the track, and leased them to a competing solvent railroad. The physical rail backbone survived and basically powered the entire 20th century. Today, GPU clusters running standardized CUDA workloads are functionally identical to those locomotives.
I have to push back on functionally identical.
But they are mobile, plug-and-play, transferable assets. If a secondary AI startup defaults tomorrow, the special purpose vehicle, the SPV trustee,
Right.
can simply reallocate those exact same NVIDIA H100s to another tenant over the cloud. They don't even have to send a technician to the server rack to unplug anything. It's just soft routed. How can you compare this to the doomed, buried, dark fiber of the 1990s telecom crash when our modern compute collateral is entirely plug and play?
Look, the concept of soft routing is a compelling argument for mobility. I'll give you that. But you are ignoring the fundamental difference in the rate of decay. A locomotive built in 1870 could still pull freight efficiently in 1890. It did not lose half of its physical utility in 18 months.
Sure, the timeline is compressed, but the principle...
The timeline is everything here. You brought up the 1990s telecom crash, and it is true that dark fiber was non-transferable because it was physically buried in the dirt. GPUs are conceptually mobile via the cloud, I grant you that, but their economic utility decays at a terrifying speed. The better historical parallel isn't the railroad, it's the IBM mainframe overbooking hazard of the 1970s.
Oh, you're referring to the computer leasing firms that went under when the architectures changed?
Yes, exactly, and the mechanism of their failure is vital to understand here. In the 1970s, leasing firms assumed IBM mainframes would retain 50% of their value after 5 years.
Right, that was the model.
That was the model. They built their entire debt structures around that specific residual value. But then IBM slashed prices and launched vastly superior new models. The secondary values of the old machines collapsed overnight, and the leasing firms were completely wiped out.
But that was a miscalculation of residual value. That's a pricing error.
It's an architecture leap error. Today, when NVIDIA shifts from the Hopper architecture to Blackwell, performance leaps 2 to 3 times. Older hardware doesn't just get a little slower, it plummets in resale value by 30 to 60% in 12 to 18 months.
Yeah, but
Transferability means absolutely nothing if the asset itself is essentially e-waste by the time it is repossessed. You can reroute the server all you want, but if no one wants to rent it because it's too power inefficient compared to the new chips, your collateral is completely worthless.
that assumes the financial engineers structuring these deals are ignorant of Moore's law, which they are obviously not. I mean, Wall Street is intimately aware of the technological obsolescence curve, and they have built bulletproof structural safeguards into the math to mitigate exactly what you just described.
Bulletproof is a very strong word.
Well, let's look at the structures. This is not the 2008 subprime crisis with zero-down loans and a blind reliance on asset appreciation, right? The AI ABS market is utilizing highly bespoke conservative engineering. Let me break down the mechanics because they really matter here. First, we have massive equity subordination.
Right, the cash cushions?
Right. The sponsor putting together the deal has to put up a 25 to 40% equity cushion in pure cash. That means if the value of the GPUs drops, that entire massive chunk of sponsor money has to be completely vaporized before a bondholder loses a single dime.
Okay, but
And second, and this directly addresses your IBM mainframe point, they aren't writing 10-year loans on these chips. The debt features accelerated 3 to 4 year amortization waterfalls. The debt is structured so that the heaviest payments are made right up front, while the chips are brand new and commanding top dollar.
so they're paying it down aggressively early on.
Exactly. The principal pays down incredibly fast, specifically matching the high-margin frontier training lifespan of the GPUs. And on top of that, they're backing these deals with residual value insurance, or RVI, from rated insurers to guarantee a cash floor. If the chips sell below that floor at the end of the term, the insurer pays the gap.
Right. Look, I understand the mechanics of those safeguards, but I just do not believe they are a panacea for the sectoral risk we are building. I'll concede this won't cause a 2008 systemic commercial banking meltdown. The leverage isn't 0% down, and we aren't dealing with subprime retail consumers. We're dealing with accredited institutional investors.
Right, sophisticated capital.
But let's look at the velocity and scale. This market is scaling 2 to 3 times faster than early MBS did. We are heading toward a $150 to $300 billion market, and the structural mismatch in the contracts is glaring.
Where is the mismatch? I mean, the anticipated repayment dates on the loans are strictly aligned with the hardware depreciation curves.
The mismatch is in the offtake contracts versus the amortization schedule. Yes, you have a 3-year amortizing loan, but what happens when a secondary neocloud provider uses a 2-year cloud customer contract to back that 3-year loan?
Well, they release it.
But after 24 months, the primary customer contract expires. In year 3, the lender is fully 100% exposed to the secondary market value of a GPU that is now 2 generations old. You mentioned residual value insurance guaranteeing a floor. RVI is provided by reinsurance pools.
Right.
If there is a massive, sudden glut of older GPUs hitting the market simultaneously because a new architecture dropped and those 2-year contracts ended, those insurers are going to face correlated systemic claims across their entire portfolio. An insurance floor only holds up if it isn't tested by the entire market all at once.
Wait, walk me through that. I really want to push back on the vulnerability of these structures. If a $1 trillion hyperscaler company signs a 15-year lease on a data center, and we are seeing these massive triple net leases where the tech giant covers the rent, the taxes, the insurance, and the maintenance.
Yeah, the triple nets are everywhere right now.
Right, so how can they just walk away? Doesn't the contract explicitly prevent the tenant from abandoning the asset just because the tech changed?
It prevents the tenant from abandoning a corporate lease, sure. But you have to look at how these off-balance sheet vehicles are legally structured. They use special purpose vehicles, or SPVs.
Right.
An SPV is a bankruptcy remote entity. The debt is secured only by the assets inside that specific vehicle, not by the parent company's total balance sheet. If a specific data center campus or a massive GPU cluster becomes a toxic asset because of a sudden shift in technology or a drop in demand, the structure is designed to insulate the parent company, not the note holder.
Meaning if it goes under, the parent company is safe.
Exactly. The SPV shields the tech giant. They can technically let that specific entity fail. The pipeline we have built, funneling hundreds of billions from private credit warehouses where the construction is funded, and then chopping it up into bonds sold on Rule 144A public ABS markets to pension funds, that pipeline has a fundamental duration mismatch with the silicone it relies on.
See, you are looking at the expiration of a 2-year offtake contract as a cliff, where the hardware suddenly becomes valueless if the primary tenant leaves or the SPV restructures, but you are ignoring the life cycle of compute. Older GPUs don't just become worthless e-waste, they simply shift down market. We call this inference downcycling.
The margins on inference are pennies compared to training frontier models, though.
Which is the whole point of the waterfall structure. When a GPU finishes its 2-year stint training the next massive frontier AI model, it transitions to running AI inference. Inference is the daily routine work. It's the chatbot queries, the fine-tuning, the image generation. This downcycling will maintain a baseline of lease revenues that is more than enough to cover the tail end of an amortizing debt.
I just don't buy that the math works out that cleanly.
Think about commercial aviation. A brand new Boeing jet flies premier international passenger routes. 15 years later, that exact same airframe is flying domestic overnight cargo freight. It is less glamorous, it commands a lower premium, but it is highly profitable.
Okay, but airplanes and data centers are completely different beasts.
But the principle holds. Downcycled GPUs will power the vast majority of daily AI software. This process will gently drive down the cost of AI inference towards zero, which will spark a massive economic boom for autonomous software. It is a planned obsolescence waterfall. It's not a cliff.
I understand the cargo plane analogy, but it severely misunderstands the physics and economics of power consumption in modern data centers. An older plane burns roughly the same amount of jet fuel as it used to. An older GPU rack takes up the exact same physical space and burns the exact same massive amount of electricity to do a fraction of the compute of a new rack.
Right. They are less efficient.
They are terribly inefficient. Data centers have a hard physical cap on electricity from the local grid, say 50 megawatts. It isn't just about the cost of power. It is about slot scarcity.
But the capital cost of the old chip is effectively zero at that point. The debt is mostly amortized.
The chip is zero, but the megawatt is not. Power is the ultimate bottleneck. No data center operator is going to waste a precious megawatt of capacity running 3-year-old chips for pennies on the dollar when they could slot in the latest hardware and charge an absolute premium.
Well, if the demand for frontier models holds up, sure.
At a certain point, it costs more in electricity to run the old chips than it does to just buy the new ones. And this brings me to the fundamental danger of off-balance sheet vehicles. When you pump billions of dollars of institutional private credit into Phase 1 construction and then refinance it into Rule 144A public ABS markets in Phase 2, you are permanently decoupling the capital investment from the immediate reality of software revenue.
You're funding future capacity.
Yes, the capital markets are saying, build it and they will come. This guarantees an overbuild. It absolutely guarantees a glut.
But an overbuild in infrastructure is historically exactly how we get the golden eras of technology. The overbuilt rail lines created the national consumer market. The overbuilt fiber optic cables in the 1990s gave us the modern internet. A glut of compute is a good thing for the economy.
A glut is fantastic for the consumer, yes. But the people who funded the overbuild got completely wiped out. When rental prices for compute inevitably crash due to this glut, the Tier 2 neocloud providers, the ones who don't have their own proprietary software ecosystems to fall back on, they are going to default on their SPVs.
Right, the smaller players are at risk.
And here is the truly cynical part of this whole structure. Big tech has brilliantly offloaded the risk. When the defaults happen, the institutional investors holding the BBB or equity tranches of these ABS deals are going to take 20 to 50% write-downs.
That's a worst-case scenario.
And who is going to step into the wreckage? Big tech. They will swoop in, buy up the overbuilt, distressed compute capacity for pennies on the dollar, and leave the pension funds and life insurance companies to absorb the massive financial blow. It is the 2001 telecom bust all over again, just with silicon instead of fiber.
Look, I see the parallel you were drawing to 2001, but the institutional bond desks buying these tranches are not naive retail investors buying Pets.com stock in the late 90s, okay? We are talking about highly sophisticated, qualified institutional buyers.
Sophisticated buyers can still misprice risk.
True, but they are earning an illiquidity premium in the private credit phase and investment-grade yields in the ABS phase, specifically to take on that calculated risk. And the structures they are using, like the master trust frameworks, are highly adaptable.
A master trust doesn't change the underlying silicon decay.
No, but it changes the risk profile over time. A master trust allows a data center operator to continuously pull new properties and newly upgraded GPU clusters into the existing securitized structure.
Right, rotating the assets.
Exactly. As the old debt amortizes and older chips are cycled out, new high-value collateral is rotated in. It isn't a static, dying pool of assets. Furthermore, you keep treating the secondary cloud providers as completely exposed entities. But many of these ABS structures feature those triple-net hyperscaler backstops we discussed.
Some of them do, yes.
Right, and even if the SPV allows for bankruptcy remoteness, the credit rating of a 15-year lease backed by a $1 trillion mega-cap firm makes that credit risk nearly equivalent to the hyperscaler's own corporate debt. It is incredibly stable. It attracts incredibly sticky, conservative capital. The system is designed to bend, not break.
Even with accelerated amortizations and master trusts, you are still betting that there won't be an exogenous shock to demand during those 36 months. You are betting that the inference downcycling market will flawlessly absorb the exact volume of chips rolling off the Frontier training lines at the exact price point required to keep the residual values above the insurance floors without running into power slot constraints.
I mean, it's a dynamic market, yes.
It requires perfect economic orchestration in an industry defined by chaotic, exponential disruption.
Well, let's step back and look at what we've covered today, because I think we've reached the core of the matter here. We both recognize that the velocity of AI securitization is unprecedented, and we both completely agree that this is structurally distinct from the 2008 subprime mortgage crisis.
Absolutely.
There are no retail consumers being preyed upon, and the upfront equity cushions are massive. From my perspective, the bespoke structural frameworks Wall Street has built, the master trust, the accelerated amortizations, the massive sponsor cash requirements, they successfully insulate this market from systemic contagion. By solving the balance sheet bottleneck, this financial engineering is actively paving the way for hyperabundant compute, which will usher in a sustained technological golden era.
And I will conclude by saying that while offloading risk from big tech to private credit and ABS markets absolutely extends the runway of this current boom, it merely shifts the blast radius. It does not eliminate the risk. It transfers it to institutional portfolios. The structural realities of rapid GPU depreciation, the unforgiving mathematics of data center power constraints, and the inevitability of capital gluts make a severe sectorial debt restructuring unavoidable. The compute will survive, but the institutional investors funding it are going to take a very painful haircut.
It seems we are leaving our listeners to weigh a profound question. Will the inevitable glut of hardware result in a soft economic transition to an era of cheap, ubiquitous compute, or will it trigger a brutal financial reckoning for the pension funds and institutional investors quietly funding the revolution?
It really is a trillion-dollar question. And the underlying complexities of tech hardware lifespans and how they interact with fixed-income bond math offers so much more to explore.
We have basically built a multi-billion-dollar dam in the digital stream. The only question now is whether the water will flow through the turbines as planned or simply wash the concrete away. Thank you for joining us for The Debate.